The first lie you were taught about insurance is that it is a product. It is not. It is a contract with a stopwatch, and the stopwatch usually starts with you paying and ends with you waiting. And here is the part nobody wants to say out loud. Most people who buy the feel-good insurance plans never get the payout they were promised because the payout is designed to arrive only when it is already too late to matter. This is financial education, not financial advice. I am going to talk about the mechanism, the incentives, and the language tricks. And I am going to connect it to 2026 because right now you are being pressured from every direction. Your job is under threat from AI. Your rent is eating your future. The Fed can cut rates and still you will not feel relief. And the wealth gap keeps widening like gravity. In that environment, it is almost criminal that so many insurance sales scripts are built to make you ignore the most important detail of all, timing. What you will learn is simple, and it is uncomfortable. You will learn how return of premium and pay for 10 years only plans are sold like a gift. You will learn how the company profits even when you do get something back. And you will learn which parts of insurance can actually protect you and which parts exist mainly to harvest your money for years. Before we go further, think about the last time you were told to be patient, not to invest wisely, not to earn more, just to wait. Wait until retirement. Wait until the market recovers. Wait until your savings grows. Wait until the claim process finishes. Wait until you are old enough to finally receive what you paid for. Now imagine somebody convincing you that waiting is not a risk. Imagine them calling it guaranteed peace of mind, while they do not tell you the worst part, what the contract really does to your purchasing power, your access to funds, and your ability to use the payout when you actually need it. Pattern interrupt. If you feel angry reading this, good. That anger is not irrational. It is your brain noticing that you were trained to misunderstand math as comfort. Let me tell you how the script works in the real world. You meet someone who sounds friendly and competent. They do not come in swinging. They come in with a story, and then they wrap the story in numbers. They tell you if you pay for 10 years, you can take back your principal. Your money comes back. Your money is not lost. Your money is growing quietly with compound interest. And they add the cherry on top. If you live, you get it back. If you die, your family gets the payout. So on paper, it sounds like you found a loophole. No more payments after the 10-year mark. No more waiting forever. Just peace. They say you are not paying for nothing. They say your policy is like a savings account. They say this is financial protection plus investment upside. But notice the structure. They promise the existence of a benefit, then they hide the condition under which it becomes usable. And the condition is always the same kind of condition: time. They do not tell you when you can actually access the money. They do not explain the age thresholds clearly. They do not emphasize the fact that the payout schedule is not built around your life. It is built around their pricing assumptions, their actuarial models, and their cash flow needs. So you think 10 years is the end. It is not. 10 years is usually the end of the payments, not the end of the lock-in. Here is a brutal example. Let us say you buy a policy with return of premium language. You are told, pay for 10 years and then you stop paying. Then you can recover your principal. Sounds clean. Sounds fair. Then you call the company later, because now you want to use your money to solve a real problem. Maybe medical bills, maybe job loss, maybe a divorce, maybe a roof that is collapsing, maybe a relocation, because insurance companies are pulling out of entire regions due to climate risks. And then they tell you the truth in calm customer service English. They say you have to wait until a specific age, sometimes around 80. Until then, the money is not really yours in the practical sense. It is just sitting in an account controlled by the contract. So congratulations. You prepaid for the privilege of not being able to solve your problem. Cliffhanger. But that is only the first layer. The deeper layer is where the real theft hides, and it is not the part you think. Now let's talk about why return of premium is emotionally powerful and financially profitable. When you are sold a plan that pays you back even partially, your brain treats it like a win. You imagine yourself getting your principal back and feeling smart for doing the safe thing, but the contract is not a savings account. It is an insurance product with insurance math baked in. That means it has two competing forces: protection and investment-like behavior. If the policy has savings-like features, the company must charge enough to cover costs, commissions, risk reserves, and the cost of the protection layer. Then it invests the remaining amount over long time horizons. The company does not need to scam you with a spreadsheet trick. They just need you to misunderstand what long-term money does in a world with inflation and rising expenses. In 2026, inflation is not just a headline, it is lived experience. Your salary buys less than it did in 2019. Real purchasing power did not return just because inflation prints improved. Your bank might show interest rates that look higher, but the cost of housing, healthcare, insurance, childcare, and debt service keeps dragging your life down. So when you are told you will get your principal back, you are not being told the real question: what will your principal buy at that future age? Because purchasing power is what matters. Money is not calories. You cannot survive on a number. You survive on what the number can purchase. This is why the return of premium promise is often a psychological mirage. You are not guaranteed a future value you can use. You are guaranteed a nominal amount under a schedule you cannot control. Pattern interrupt. In 2026, the economy is not rewarding patience the way people were trained to believe. Patience often means watching your life shrink, and now we connect it to the insurance sales language about compounding. They will say, your money compounds. That sounds like wealth building. But compounding in insurance is usually compounding on a pool that is heavily used to pay commissions and cover costs. It is not compounding in the way you imagine when you think of investing in broad, transparent markets with low fees. It is compounding inside a contract designed to keep you paying long enough for the company to win on time and friction. Even worse, some return of premium structures behave like a bet with a refund clause. You are still not truly guaranteed the net result you imagine. The refund might arrive only if you hold the policy until the end of a period and comply with conditions. And the worst part is what happens when you try to leave early. Most people do not read the fine print until something breaks. In your 20s, you might be healthy and busy. In your 30s, you may think you have time. In your 40s, you finally notice the job market changed. In your 50s, you might get hit with a health event and suddenly the contract terms become your enemy. So let me describe the moment people realize they are trapped. They pay for years. Then life happens. Maybe a layoff arrives because AI replaced half the middle management role you counted on. Maybe your rent spikes again and again. Maybe your savings is wiped by medical costs. Maybe your income drops and you need cash now. You call the insurance company and ask for a withdrawal. You expect some level of access. They do not say no in a dramatic way. They do it in a bureaucratic way. They talk about surrender charges. They talk about how the policy needs time to mature. They talk about how you would receive only part of the value. Sometimes early exits can cost you so much that you effectively lose most of what you paid. The contract punishes you for leaving, so you are not trapped because the company wants to hurt you. You are trapped because the business model requires it. The surrender fee structure is what funds commissions, keeps the policy profitable, and offsets the risk that you might have used your money elsewhere. Open loop. Remember the phrase return of premium? We will come back to how premium return is often not a refund. It is a relabeling of a lock-in. Now I want to make this real with a micro story, because abstract explanation does not change anyone's behavior. Only recognition does. Picture a 35-year-old nurse named David. He works nights. He watches patients decline while he tries to keep his own stress low. He is not stupid. He is not lazy. He is tired. David hears about a plan from a former acquaintance, someone he has known for more than a decade. The salesperson speaks like a friend. They know David likes stability. They know David wants something that feels safe, especially after years of watching the economy behave like a roulette wheel. So David buys the policy. It has a warm narrative. Pay for 10 years, and later you get your principal back. It has a moral narrative too, protection for your family. David signs. 1 year later he changes jobs because his hospital is restructuring. His income is lower. Rent is higher. His partner needs support. Then a relative gets sick, and David needs cash immediately. He calls the insurance company to ask about early withdrawal, and the response is not rage. It is worse than rage. It is calm, systematic language about surrender value and time schedules. David learns he can withdraw only a fraction. Sometimes it is so low it is hard to believe he paid so much for so little access. He realizes he was not buying savings. He bought a waiting room, and while David is in the waiting room, the world keeps moving. The job market shifts. The cost of living does not pause. The Fed's rate decisions might change borrowing costs, but they do not reverse wage stagnation. Housing remains detached from income, so even if rates drop, the damage is already embedded in rent and prices. Cliffhanger. And once you understand the waiting room trap, the next question becomes even more uncomfortable. Why does the industry push these products so aggressively when they clearly frustrate people? Let's answer that without conspiracy theories. Insurance sales incentives are not designed to reward you with the best outcome for your life. They are designed to maximize the company's economics and the salesperson's compensation. When a product combines multiple features inside one policy, the complexity increases. Complexity is profitable for sales. It increases the commission base. It increases the ability to sell everything as one bundle. It also increases the chance that you will not compare fees or understand the net performance. In 2026, that matters even more because so many people are overwhelmed. AI is erasing roles. The creator economy sells dream jobs while most people earn zero.
Social media is full of passive income videos that quietly ignore taxes, fees, and the basic truth that wealth comes from ownership, not from vibes.
So when an insurance agent shows up with a polished story, it competes with your fear. Fear is a powerful buying motivation. The agent tells you what you want to hear. You do not lose, you get it back. You protect your family, you can stop paying after 10 years, and you feel safe. That emotional safety is exactly what the company buys with the design of the product. Now let's go darker. Let's talk about the part that makes this whole thing feel like an unfair game. The company does not actually need you to be profitable in the way you think you are supposed to be profitable. They need you to fund their machine for long enough. Insurance companies collect premiums now and pay out later, sometimes decades later. During that time, they invest. In the past, people imagined insurance as simple risk pooling. That is the surface story. The deeper story is asset gathering and investment management at scale. In 2026, this investment role matters because global debt levels have surpassed $300 trillion. Governments and corporations are constantly issuing debt. Markets are constantly hungry for capital. The financial system is a giant circuit. Insurance premiums are a stable source of capital in that circuit. So when insurance companies invest premiums, they earn returns that can fund part of their obligations and keep the business profitable. But here is the kicker. A portion of the return you are told about is not a transparent investment return. It is an internal accounting outcome after fees and reserve requirements and commissions and risk costs. So when you hear guaranteed, you should translate it mentally into contract-specific guarantees, not market-like guarantees. Also, the word guaranteed does not guarantee your timeline. It guarantees the contract schedule and the contract-defined terms, and your life does not follow contract schedules. Your life follows rent and health and layoffs and family emergencies. Now, you might think, but the company has to pay claims. They cannot just refuse. They can refuse in ways that do not look like refusal. They deny based on definitions. They delay based on documentation. They narrow coverage using exclusions. They exploit ambiguity. They use the fact that most people will not fight. That is why the industry exists. Not just because life has risk. Because incentives make people accept the rules of a system that is difficult to challenge. And now I want to bring in the Fed and interest rates, because in 2026 you are living through the results of rate policy decisions, even if you do not read economic reports. When the Fed changes interest rates, it changes borrowing costs and the yield available on safe assets. Insurance companies invest heavily in bonds and related instruments. When rates are higher, their investment income can be stronger. When rates are lower, it can compress their earnings. So during high-rate regimes, you might see more salesmanship about returns and growth. But your net benefit is still constrained by fees, lock-in periods, and the payout schedule. And when rates change, you still face the same problem. The contract is built to benefit the company from premium collection and time horizon alignment. So even if the investment environment improves, the sales promise can still be misleading because your access to money is delayed and your net value is reduced by surrender charges and inflation. Pattern interrupt. People think inflation is just about groceries. It is also about contract value. Now let's address the seductive moral pitch. If you die, your family gets money. If you live, you get money back. So you win either way. That is marketing. The contract often defines payout triggers in ways that are narrower than people assume. Life insurance can exclude causes, define contestability periods, and require survival beyond waiting windows. Medical and critical illness products can define illnesses with strict criteria. One policy might require specific diagnostic confirmations or stages, another might exclude pre-existing conditions or require that the illness meets the contract definition exactly. So even if you receive a payout someday, it might not be enough for the actual cost of your real situation, which in 2026 includes climate-driven migration and rising insurance premiums and medical inflation that does not stay still, and if you do not receive it, you are still paying for years. This is why the best insurance is boring and specific. The best insurance is the one that protects against catastrophic loss, not the one that pretends to make you rich quietly. Now you might hear me talking negatively about certain insurance products. That is not because all insurance is the same. It is because the business of savings inside insurance is where the promises become psychological and where the complexity hides the economics. Let me explain the difference between protection-focused insurance and savings-style insurance. Protection-focused insurance is designed for rare events. It is about shifting risk. It tries to give you a large benefit if something terrible happens. Savings-style insurance tries to combine risk protection with a value accumulation component. That is where the cost often grows because the contract bundles multiple purposes. The company needs to pay commissions and cover administrative expenses, and it still needs reserves for risk.
so the price becomes high. And when the price is high, the portion of your money that is truly available for accumulation becomes limited, and the portion used for risk and expenses grows, so you end up paying a premium for protection and for forced accumulation inside a structure that is not liquid. In 2026, liquidity matters because the labor market is unstable. AI is not just eliminating entry-level tasks, it is restructuring entire categories of work.
Middle-class professionals are being compressed. You may still keep your job, but you might face lower hours, different duties, and pressure to reskill for tools that evolve monthly. So if you lock money into something that charges you to leave, you are taking a risk that is not financial theory risk. It is survival risk. Now, I promised you earlier we would come back to the idea of return of premium. Here it is. Some policies promise principal return if you hold until a certain age, but if you look closer, the return might be not what you think. It might require continued premiums beyond what the agent emphasized. It might reduce the payout with fees. It might only return the principal portion, while investment-like growth is minimal. And if you cancel early, you might receive a reduced surrender value. The contract might treat your early exit as a negative outcome for the company, so it charges you heavily. So the return is designed to be a carrot that keeps you in the cage long enough for the company to profit. And that is why people feel betrayed, not because they are irrational, but because they experience the difference between marketing language and contract mechanics. Now let us go deeper into the company side, because you will never fully understand the trap until you understand why the trap is rational for them. Insurance companies can behave like banks without being banks. They collect premiums with little upfront capital costs to customers. They then invest those funds. If you have ever wondered why Warren Buffett and other investors talk about insurance like it is a machine, this is the reason. Insurance float is money the company holds before paying claims. That float can be invested. If claims are predictable, the company can earn on the float for long periods. But your policy is not your own float. Your float might be part of the pool. You are not the operator, you are the supplier of capital. And in 2026, when global markets are still driven by massive debt issuance, that pooled capital becomes valuable. So the company's profitability is tied to how much capital it can gather and how long it can keep it working. That is why the sales pitch emphasizes long holding periods. It is not necessarily because the company wants to ruin lives.